or just at the end? There we go. Recording is in progress. All right. Welcome back, everyone, to Fundamentals of Income Tax, Part 2. For those of you just joining us, having downloaded this through ULearn, this is a recorded session for British Columbia students or students who want to get the British Columbia content. Welcome back. My name is Brian. I am going to be your instructor this evening for those of you who weren't with us last time. This is my 17th year with H&R Block. If you have any questions about anything I mentioned in the talk, feel free to email me, brian.clark@hrblock.ca. But I do want to stress that I am not your instructor if you're in another session. So if you have questions for your instructor, those need to go to them. I cannot contact your instructor directly. All right. But general questions, or if I mention something in class and you would like to know more, feel free to reach out. So as always in the class, we want to stress that this is a place to make mistakes and bring your questions. This class thrives, this course thrives on the interactions between students and instructors and bringing your own perspectives to class. And because this is an introductory course, there is no such thing as a question which is too basic, particularly in the first part of the course where we are introducing basic concepts of Canadian tax and how the Canadian tax system works. And again, obviously, during class, we want to keep a nice, respectful atmosphere. Remember, this is a course which is taught all across Canada. There's all kinds of people in all kinds of situations, so that's why we want to stress a certain standard of conduct in the class. The main thing that I really try to adhere to is respecting class times. Class beginning at 6, ending at 9. For these online sessions, there are certain cases where I may need to run a little long just to make sure we cover things, but if students need to step out at 9, that's perfectly fine. It'll all be in the recording, is the idea. All right. On that note, tonight we have an introductory video for whoops, not that one. Whoops, how did that get here? Abort. Quit. No, not that one. Oh, no. Where did WebEx go? Oh, there it is. I want this window. No, you cannot watch Baldur's Gate. We are all very serious. Okay, all right. So here is the video for H&R Block. And let's go. Oh, let me know. Okay, does everyone get sound? Anyone having any issues? You're okay?
I can hear it clearly.
Okay, good. Excellent. Sometimes some people have trouble with the video. All right. Don't want to just let it. I did have a session once where I played the entire video, and at the end, some people were saying, oh, we couldn't hear anything. I always like to check. All right. There we go. Okay, so let me get back to the presentation there. All right. So a couple things about that. If you have questions about working, oh, it got blurry. Oh, had some trouble with the video. Okay, was it through the whole video or just at the end? Oh, that's disappointing. All right. I can try playing it again at the end of the session if you want to hang on. The general tone of the video, though, is fairly straightforward. It's just welcoming everybody to class and talking a little bit about what H&R Block is all about. The volume was a little low, eh? Okay. That's going to be disappointing, I think. But we can try again at the end of the session. But it was mainly talking about what H&R Block is as a company, where it's coming from, and just welcoming everyone to class. It's interesting that some of you could see it okay, some of you could hear it okay, and some couldn't. That's interesting. All right, well, we can try again at the end of class. But yes, if you have any questions about H&R Block and working for H&R Block, feel free to let me know. What I would say, though, is that while H&R Block, this course is kind of the minimum that we expect for people who are coming to work for us, we also intend this course to be a perfectly accessible introduction to Canadian taxes, which is going to be useful for everyone, whether they're working for H&R Block or not. So we are not, there's not going to be a lot of content here that's specific to H&R Block, is what I mean. The content of this course you're going to find useful whether you come work for us or not. But if you love taxes and you love people and you say, hey, this is really good, and you have a knack for this stuff, then we would indeed be very interested in talking to you. But we'll have more information about that later in the course. Are we going to review Chapter 2 today? Exactly. That's what we're here for. So, but first, we're going to touch on what we covered in Chapter 1. So in Chapter 1, and I think you're all here for that, but in case anyone missed it or anyone online missed it, remember you can look at the summaries at the end of each chapter. In Chapter 1, we talked about some important fundamental characteristics of the Canadian tax system. We talked about residency. We talked about philosophically what a self-assessment tax system is and some of the implications of that. We talked about a progressive tax system, how that works in practice, and some of the implications of that. And we talked about the big concepts of total income, net income, and taxable income, and how those have a very specific meaning in the context of the Canadian tax return. If anyone has any questions from last time, just let me know. One thing to note that when we get to the end of a chapter with chapter review problems, if you have any lingering questions about them, you can always bring them up at the start of the next class as well. All right, for today, the big picture of what we're going to be talking about, we're going to be beginning our survey, our overview of the income tax and benefit return form. And we're going to be working through it step by step to make sure you really understand mechanically the components of the form and how it works. So we're going to be looking at step 1 of the form, which is information questions and identification type questions, and the concept of foreign property reporting. We're going to be looking at step 2, where we calculate total income. And we're going to be looking at basic kinds of examples at this stage of the course. So we're going to be looking at employment income, but also the concept of other employment income. And we're going to be looking at wage loss replacement plans, which are an interesting example of something a little unusual to do with employment income. Then we're going to look at step 3, net income, and we're going to talk about the concept of deductions. And we're going to look at some simple examples of those for union dues, professional dues, or similar dues, other employment expenses. And then we're going to look at step 4, taxable income, and some more deductions associated with that. Again, with every session of the course, we are going to be looking at some learning objectives. So these are, if the agenda is kind of the broad topics, these are the specific skills we're looking to impart. So by the end of this chapter, you'll be able to complete the identification area of an individual's tax return, report the types of employment income that are shown on T4 slips, and the types of employment income that are not usually shown on T4 slips. We're going to be able to determine the amount of wage loss replacement plan benefits to include in employment income. We're going to be able to know how to handle research grants, some basic deductions for RPP contributions, PRPP contributions, and union dues, professional dues. In cases where there are repayments of employment income, how we handle those. And we're going to touch on a couple of deductions from net income to produce a lower taxable income, the security options deduction, and the Canadian Forces Personnel and Police deduction. By the end of today, you will be able to complete a tax return up until line 26000, being able to calculate all the way up to taxable income. All right. So, but first, just to make sure everyone is awake and engaged, let's begin with a simple activity. And for those of you who are here before class, we were already talking about some of this already. But for those of you who joined us right at 6 o'clock, especially, what is the first digit of your social insurance number? So just drop it in the chat. Okay, so we're seeing a lot of 7s, some 9s, and a few other ones. Well, so then the question, do you think the first digit represents anything? Right. It's not a coincidence that so many of you have ones that begin with 7s and 9s, but you might not know the full logic behind the numbers. So let's begin with the basics. So social insurance numbers have been around since the 1960s. They were created in 1964 to help administer the Canada Pension Plan, and the government found them so efficient that in 1967 they started to be used by Revenue Canada for tracking taxes and tax reporting purposes. Social insurance numbers are formatted as a 9-digit number in 3 groups of 3 numbers, and you can tell if a social insurance number is a valid possible number because if you add a series of 1s and 0s to it in a certain way, I forget the mechanics of it, but essentially you can mathematically run it through an algorithm and tell if it is a legitimate possible social insurance number. The details are on Wikipedia. It's called the Loon algorithm. And what this means is if you just put any grouping of 9 digits and enter it as a SIN number, software will be able to tell if it is a possible social insurance number or not. So what this means is if you put in a number for tax software and it comes back with, this is not a valid social insurance number, it doesn't mean that it's the wrong social insurance number for that person. It simply means that it is not a possible social insurance number. Another way to put that, if you don't get an error like that, it doesn't necessarily mean you have the right social insurance number for that person. It just means that it is a possible social insurance number. So the system is set up like this. So there are regional codes that are associated with the numbers. So 1 is used for Atlantic Canada and overseas residents. 2 and 3 are for Quebec. 4 and 5 are for Ontario, except northwestern Ontario near Manitoba. That is folded into 6, which is the Prairie Provinces, the Northwest Territories, Nunavut, and northwestern Ontario. For those of you who may be newer in Canada, Nunavut and the Northwest Territories used to be part of the same region. So that's part of that grouping there. 7 is reserved for the Pacific region, BC and the Yukon, and 8 and 0 are not used for tax purposes. 9 is for temporary residents who are neither Canadian residents or permanent residents, but nonetheless need to file taxes. 8 and 0, when we say they're not used for tax purposes, this doesn't mean they don't exist, but 8 is reserved, for example, for testing and documentation purposes, and 0 is for special circumstances where a number is needed, but it's not going to be used for tax purposes. You can think of it as extremely short-term SIN number. All right. So, and this is all important because it's one of the things that helps to identify who you are when you file your taxes. So the first part of the income tax and benefit return is step 1. And on the top of the first page, you have to enter your identification information right up here, your name, last name, your mailing address, and then also the social insurance number, the birthday. So the combination of your name, your social insurance number, and the birthday is used to validate that this is the correct person when you file taxes. If you don't have that correct, then it will generate an e-file error. Now, and again, if you want to follow along as we are doing this, you can pull up a copy of the T1 on another screen or on a tablet. Escape. There we go. So that can be, you can have that in your downloadable fillable forms. So the one for British Columbia, again, within the fillable forms, you can find the relevant provincial form here under province, BC. The one that's in the slides is the generic one, which is the 5015R. Right down here. And again, the version of the form is identified at the lower left. For us, though, the one we will be using in this session of the course is the one for BC, which is the 5010R. And again, I touched on this last time. 10, the numerical designation is simply that if you begin at Newfoundland and count west, British Columbia is the 10th province. So 5010R is a little code at the bottom just to tell you what version of the T1 form this is. So you can follow that along at home as I'm going through. Oops. So with the information section of the return, then it's very important to have this accurate because it, if you make errors in this area of the form, they can be a real pain to correct. One thing to note with the mailing address, when you file your taxes, you can use that to update your mailing address. So it doesn't matter if it's the same mailing address as the last time you filed taxes, and it does not need to be the mailing address you had if you're filing these taxes after the fact. So if I'm filing taxes for 2020 and in 2020 I lived in Alberta, I would use my current mailing address here. You can also update your mailing address using My Account or just sending a letter to the CRA. There's a special form in the textbook called an RC 325. It's not possible for tax preparers like me at H&R Block to update your address with the CRA unless we are filing taxes for you. And this is generally true of the other personal information in this section as well. So your marital status over here, we can't update that using Represent a Client. That needs a separate form sent to the CRA as well. Other things, now we'll talk later on in the course about the specific difference between some of these marital statuses, the difference between married and common law, and the difference between separated and divorced. So we will talk about those later in the course as well. But in general, information in this section, while you can update it at the time of filing tax, outside those times only the taxpayer can update it by contacting the CRA directly. Now, one thing you will also note here is that there's a section for email. Now, email, it says right on the form, this is only entered if you want to register for emails from the CRA, and so the CRA will no longer send you paper notices of assessment. Instead, or letters, it will simply send you a notification that you have a message waiting for you on My Account, right? So in cases where someone doesn't want to do that, we do not enter their email. It's important to stress that when the CRA emails people, there is a real risk of fraud for people interpreting an email as being from the CRA when it's not. But there are some things we can look for. So a genuine CRA email, they will always send emails in both official languages, and they will not include any links in the emails they send. They will not ask for or send any private information via email. It'll simply be, please go to My Account and sign in. And they will not include a link in the email. Any emails that are not consistent with these rules are going to be fake. And these are phishing attempts, and they should be reported to the Canadian Anti-Fraud Center. Also, CRA emails are bilingual. And that is English and French. Criminals are becoming more sophisticated over time with the rise of AI. I think we can anticipate this is only going to get more sophisticated over time. Generally, these phishing attempts are aimed at people who are a little less tech savvy, but I don't think we can be complacent. It's important to just be aware that this happens, and it's something to keep an eye on. So let's give you a chance to be a bit interactive here. Have a look at this slide and tell me, are there any signs that whether or not this is a legitimate email? And just drop those in the chat. Or if you think this is a legit email and there's nothing wrong with it, then put that in the chat. But be as specific as possible. All right, you seem to feel it's illegitimate, but why? What are the signals? Good. So there are some links here we can see. Good. There. I notice that it's not to a person. It's not Dear Peter. It's Dear Address. There's a link here. Again, not good. It's not sent from an actual Government of Canada email address, is it? Although we can assume in some email programs that sometimes might be masked. So we need to be careful. It says CRA. It's only when you look at the details that you can tell that that's incorrect. An expiry date. Yeah, what is that about? That doesn't make any sense. It's also, the CRA does not send email, does not send money via e-transfers. It's either by check or direct deposit. It's good. It's not bilingual. There's no French here. And they mention a specific amount. So that's personal information. Right? There are a lot of red flags here. So we can anticipate scam emails are going to get more sophisticated over time. We should also be aware of the possibility of telephone scams. So people may phone up individuals, especially around tax time, and some of them are quite crude. And people may get a phone call saying, I'm from the CRA, you owe a large amount of money, and if you don't pay it, you are going to prison, so you need to come down to the 7-Eleven with some gift cards. Or, someone telling them they are getting a large amount of money and they just need to confirm their banking information to receive it. In general, when we're doing tax for people, we need to be keenly aware of the sensitivity of the private information involved. And we need to often educate our clients about the need to guard themselves against this kind of thing. And so we can simply let them know, here's what the CRA is, this is what the CRA does, and these are things the CRA would never do. All right. Now, for the next part of page 1, we talk about residence information. Now, we touched on this in last class, but it's very important to stress that your residence needs to be correctly reported on the tax return, particularly for your province of residence. And if there are ambiguous cases, there are ways to determine it. So, for example, if someone is living in one province, working in another. So we enter the province of residence as of the end of the year here. And then this one, your current province or territory of residence, that's important because remember, this would be for 2024. This would be for April 2025 or whenever they're filing the tax, because sometimes your mailing address will be different from where you are actually residing. And there are some provincial credits which are based on your province of residence. So it's important to let the CRA know if you are moving within the year, because it may change your provincial eligibility for certain benefits. Also over here, you can note if you became or ceased to be a resident of Canada. And although those part year situations are beyond the scope of this course, it is also something which is identified right up front on the first page of the return. And how many days are required to live in one province? That's a good question, Mohammed. And it's not based on days, by and large. It is instead whether you're actually living there, whether you've actually moved there. So conceivably, you could move to British Columbia on December 31st, 2024, and then you would be a resident of British Columbia, even though you moved right at the end of the year. It's not the duration that matters, it's whether or not it's an actual move. Did you actually change your address? Are you actually living in the new place? And things like that. In ambiguous cases, there's a series of tests we can apply. As I think I said last time, the CRA, for questions like these, the CRA's official phrase is that they regard it as a question of fact. So is your name on a lease? Do you have utility bills? Have you continued to live there? And so on. Normally, it's reasonably straightforward to determine whether a move has occurred. It gets more complex when someone has more than one place where they are living or more than one province where they are working, but in general, we can normally make a determination. But yeah, the duration of it is less important than whether or not it's a genuine move, as the CRA would put it. We also put down spousal information at the bottom of page 1. It's important to stress here that while we need some information about the spouse here, this does not mean we're filing tax for the spouse or that the spouse is filing taxes at this time or at all. Note the key phrase, the amount that it would be if they filed a return, right? So the spouse may not be filing at this time and may not ever file, particularly if the amount is 0. All that you need, the minimum that you need is the spouse's first name, their social insurance number, and the amount of what their income would be. And you can use an estimate because obviously if they haven't filed yet, you may not have that exact number. If it affects anything in the return, if and when they do file, the CRA will make an adjustment at a later time. We are going to talk more about the implications of spousal income later in the course. In this early part of the course, we are just talking about the implications of looking at simple tax returns done by a single taxpayer, just to keep things simple in the early part of the course when we're just trying to understand how the tax return is laid out and how the taxes are calculated. All right. On page 2, question about if you live in BC but lived in a different province in the same year, could you claim the rental credit for the other province or those months towards it? It depends on the provinces involved and what the specific credit is. So, for example, something like, and we haven't talked about any of this in the class yet so far, but to give you an easy example, for the BC rental tax credit, you need to live in BC a minimum of 6 months. And it's only your BC rental address which qualifies. So it needs to be an address in BC paying rent in BC. When you were a resident of another province, you weren't eligible for the credit, so those months don't count. Similarly, for GST rebates, often there's a provincial benefit attached to it. When you change provinces, you cease to be eligible for the provincial component of that benefit. And so I often see people who wind up owing a little bit, need to repay some of those benefits because they moved from BC to Ontario or Manitoba to Saskatchewan and didn't notify the CRA right away. And so they got 3 or 6 or 9 months worth of these provincial benefits that they weren't entitled to. Okay, so we will talk more about provincial stuff in a later session, but yeah, that's basically it. It depends on the rules of the individual credit. Now, the Elections Canada question here is common to all versions of the form, and it is simply to help Elections Canada update the voters list. So, first question is, do you have Canadian citizenship? You can only vote in a Canadian federal election if you have Canadian citizenship. So if the answer is yes, then you can answer the second question, do you authorize the CRA to give your address information from this form to Elections Canada to update the voters list? Now, the answer can be no. This is entirely optional on the part of the taxpayer, and people can have numerous reasons for saying no. Perhaps the address on the tax return is just a temporary one, so they don't want it going on the voters list. Perhaps they are uncomfortable with Elections Canada having the information just sitting around. If people don't want to do this, we can let people know that they are able to go register to vote through their local Elections Canada office at any time. So that's not firmly going to be an issue. But this is just one mechanism that Elections Canada uses to help keep the voters list updated. For us, the key point is that only Canadian citizens can answer the second question. So we sometimes need to be careful of that, particularly when we're dealing with permanent residents who may have been in Canada for a very long time and, are citizens in all but name, but technically speaking, they still can't go on the voters list. And again, this is the federal voters list only. There may be some municipal elections, and I'm not familiar with the latest. There might be an individual province where permanent residents can vote. But again, this is only for the federal agency, Elections Canada. All provinces have their own agency. In British Columbia, it's Elections BC, and they potentially have their own around that. Now, if someone is a First Nations person and they have been working on a reserve, in some cases they may have income which is exempt from tax under the Indian Act. So in this case, they tick the box here. Now, First Nations issues, while they're not that complicated, they are not part of this course because they are a separate small course that we offer for our employees. But the short version of it, anyone who is a status Indian has that status and is working on a reserve may qualify to have exempt income, and so they would tick this box here. Okay. I believe it's true, Valerie. I think the T90 is a supplemental form, and then depending on how it is reported on their T4, it may or may not go into the 5010R. But I haven't looked at that course in a little while. And in particular, I haven't looked at the T90 in a little while. But I think the intention there is for that any income which is not going in the regular form will be on the T90 for information purposes. All right, but again, that gets a little outside the scope of this course, so I'm less comfortable with that. If you want me, just shoot me an email about that, and I can look into it because that is an interesting question that I'm more than happy to have a look at when I get a moment. Related to that, many provinces have questions which are specific to them. So the variation in the federal T1 forms, the provincial variations, tends to all happen on page 2. Depending on the province, you will see various questions specific to that province. So the top one is for Newfoundland. This is for Northwest Territories. This is for the Yukon. So for people taking the course in those regions, these questions would be more relevant. Until recently, there were a couple questions like this on the BC form. If you're in a province where the Canada carbon rebate applied, it's being phased out now, then you would have a question about the Canada carbon rebate. And for anyone who's unfamiliar, because this didn't apply in BC, in provinces that were subject to the federal carbon tax, those taxpayers received a rebate to compensate them for the tax. BC was never subject to the federal carbon tax and so didn't get this rebate. What BC and Ontario and Nunavut have, though, is a question about organ donation. So for BC, for example, you can have the option of the CRA sending your information to the provincial organ donor registry for more information. It is not putting your name on the registry itself. It is simply requesting more information. Right, and if we can go into this when we talk about BC specific issues in Chapter 5. All right, but one thing which is common to all provinces and to all taxpayers, there is a question on page 2 about foreign property reporting. And this one is quite important, so we want to stress it a bit, and there are going to be some assignment and exam questions about it. So the question reads, do you own or hold specified foreign property? And is the cost value more than $100,000 Canadian? Now, a lot of people get thrown off by this and they have questions about it. The first thing to understand is specified foreign property has a very specific meaning. You can think of it as foreign property with the potential to generate income. So it doesn't include personal use property. It doesn't include foreign property that is held in a registered plan in Canada. So if your RSP has foreign stocks in it, that's not part of this. If there are foreign investments in Canadian mutual funds, so if you have some Canadian mutual funds and they hold some U.S. stocks in them, that's not what this is about. And if it's property used or held exclusively for business, then that doesn't need to be reported here. So the key thing is, if you have foreign property, the question is such that if you have any property outside Canada, it doesn't matter what kinds of property you have, if they are specified. It's the total of all your property. So if you have $20,000 in a bank account here, and you have $50,000 in property here, and you have $40,000 in investments in a third country, it's the total of them all together. And is the total cost value more than 100,000 Canadian? Now, cost amount is a concept you might not be familiar with. This simply means how much you paid to acquire the property. What is its initial value, as opposed to what is its current value? So, current value we often refer to as fair market value. So that is, what if you sold that property today? What if you sold those stocks today? And that can be higher or lower than what you initially paid for it, which is the cost amount. And the value has to be in Canadian dollars. So if you bought something in US dollars, you need to figure out what that was in Canadian dollars at the time you purchased it. Key thing to note about the T1135 is that it is a separate form which is filed from the tax return, and it can be filed at a different time from the tax return. But it's important to note that with the T1135, unlike the tax return itself, it is penalized if it is filed late, regardless of whether or not you owe tax. So it is $25 per day that it is late, up to a maximum of $2,500. So it'll hit the maximum over 100 days, after 100 days, which is pretty rapid. So if someone has foreign property or potentially has it, it's very important that we let them know about it and we make sure that it gets filed. But it is not part of the tax return itself. It is filed independently. All right. So let's look at an example to help make this a little more concrete. Jordan, resident of Ontario, living in Thunder Bay, has purchased a vacation home in Raleigh, North Carolina in 2014 for 400,000 Canadian. He stays there 4 months of the year. The home is vacant the other 4 months. As of December 31st, the home is now valued at 525,000 Canadian. Should he file a T1135 for 2024? Okay, some yeses, some nos. Get a few more answers here. There you go. So Valerie has pegged it. The key factor here, so the cost is high enough that this would be reportable if it were a specified foreign property, but this is a personal use property, right? He uses it as a vacation home. He lives there 4 months of the year. and the home is vacant for the other 8 months. He's not renting it out. There's nothing to indicate he intends to rent it out. It is essentially a second residence. So in a case like this, a T1135 would not be required. It's not just that he's not generating income from it. He clearly has no intention of generating income from it. There's nothing to indicate he's developing it for business, and so on. It is possible in the future that he could be changing it to be an income-generating property, or, it can change back. It's possible. So its status might have been different in the past or might be different in the future. But right now, for 2024, he doesn't need to do so. Now, let's try out a poll question with a slightly different example. Let me pull up the poll here. And here we go. So, let's pull that up. So, a taxpayer has a rental property in the United States, which is worth $245,000 US. They purchased this Canada several years ago for 90,000 Canadian. Are they required to complete Form T1135? All right, so let's open up the poll and see what you think. Give you about a minute. All right, still a few people haven't answered. I'll give them another 20 seconds. It is possible they are away from keyboard or getting a snack or something, so that's perfectly fine. All right, let's close the old poll here. So kind of an even split. Some of you said yes, and some said no. The correct answer here, whoop, don't worry, that's fine. Something just fell down, that's all. The correct answer here is no, because the cost value is less than 100,000. So even though it is a specified property, like it is generating income, the cost value is below 90,000. So the T1135 doesn't need to be filed. The income would still be reported on the return, but the separate T1135 doesn't need to be filed. Okay, and Daisy has a question. If you, I'll just put that in the chat for you. Here's what she is asking. So the question was, if you have a property rented and you're paying the mortgage with that amount, is that reported? Rental income is reported on the return. It is a kind of business income, and that gets into more complex things. So we're not going to cover it in this course because it's kind of its own thing and a course in and of itself. But it would, for purposes of the T1135, mean that something is not a personal use property. So that's the key thing there. At this point, at this level, the main thing is to be able to identify when something is or is not personal use property and if its cost value is or is not above 100,000 Canadian. But also bear in mind, it is the combined value of all properties that matters. So if this person had this property but also had, say, $20,000 in Microsoft stock that wasn't in a Canadian mutual fund, or they had $20,000 in a bank account in the U.S., then they would need to report because the total value would be above 100,000 Canadian. I have seen taxpayers run into that issue in the past. So we want to stress to people that it is the total of all properties in all countries outside Canada. Yeah, the key thing is the actual cost of the property paid at the time of purchase. If it's money in a bank account, of course, that's not an issue. It's whatever the amount is in the bank account. Okay, so now we're going to go on and keep walking through the form. And again, you can follow along on the form on your tablets as we go. So step 2 of the form is where we calculate total income. Now, we touched on this in our last class, but you can see the layout of the form is such that these boxes down here, these lines, all have plus signs on them, so they are added together. The fields over to the left are for information purposes. So the CRA tracks them for information purposes, but they are not directly added normally. Down here, you can see cases where there is an information field and then a second field which is added together and put in. We're not going to be looking at that just yet. Right now we're only looking at simple examples in the course, but as you can see, the layout of the form is fairly clear. We have a column of numbers which are added together, and then at the bottom we have the total income field 15000. Now, just a note about line numbers and the layout here. I'll talk more about this in a future session, but just for now, notice that the line numbers all have 5 digits, and they are more or less sequential, but these single and double-digit numbers over here are 100% sequential. So these short numbers tell you what order the field is on the page and what order it happens in. The 5-digit codes are more for identification. They tell you what a number is, and the short numbers tell you where it is on the page. Zoom it in a little bit. Yeah, hopefully you've got this at home, but let me see if I can. Okay, I can't do this on the slide itself, but I can do it here. A little bit. Right. On that last slide, we mainly wanted you to understand the layout of the form. But yes, what I'm specifically referring to here are these 5-digit numbers here. We're going to be referring to the lot of these as we go through in these sessions. You're not expected to memorize these. We just want you to have a general understanding of them. Today, I just want to stress that these codes tell you what a number represents, and these little numbers over here tell you where it is on the page. So the first thing we're going to be talking about is employment income up here, and employment income is entered on line 10100, and we're going to be looking at these fields up here. So box 10120, box 42 on IT, 47, and so on. So again, if you have the chance to pull this up on a separate screen, please do. So employment income is specifically defined in the Income Tax Act, and it is income from a job or employment or an office. So, and this income is reported in box 14 of a T4 slip. Now, again, in this early part of the course, we are trying to keep things simple. So as we go through the big tax form, we're going to be looking at simple examples involving a single taxpayer who has income and deductions purely from employment. We are going to talk about more complex things later in the course. Now, first thing we want to stress here, what is employment income? So it comes from job, regular employment, or from an office. And for anyone who didn't get a chance to look at the textbook, or we didn't touch on this last time, the income from an office is something like a politician's job. So the mayor of Burnaby, the premier of New Brunswick, the head of the NDP as an MP, these are all offices. They are not jobs in the regular sense. These people don't have a boss in the regular sense. They don't have hours in the regular sense, but their income is set. It is otherwise similar to employment income. And so it is included on this line. Income from regular employment reported on a T4 is also included on this line, but that does not cover self-employment. Self-employment is beyond the scope of this course, but the easy way to think of it is that for someone who is self-employed or has a small business that is not incorporated, their income is reported on the T1 as business income. So we're not going to be getting into that because that, again, is its own thing with a lot of things to discuss about it. Only employment is handled here. Now, as a practical matter, it can sometimes be hard to tell if something should be reported as employment income or self-employment income. So we're going to look at a couple examples in the textbook. You're asking about gig jobs and DoorDash. Well, let's have a look at some of the guidelines around that. So if we look at the textbook over here, right down here. And again, I just want to remind everybody, particularly those of you listening on the web, if something is not covered in enough detail during the online session here, remember that there is more detail in the textbook than we can possibly cover in 3 hours. So please feel free to have a look at that if you want more detail about any of these topics. But employment versus self-employment income, right down here. That was in exercises 2-4. When you are going through the textbook, I really recommend you work through the exercises. They can often help illustrate and make something concrete from the textbook. So we have two examples here. So first, Alina works as a babysitter. She cares for a baby for several hours each day in their parents' home, So the parents determine the hours that she works and the actual duties she performs while she's in the home. So is she an employee or a self-employed individual? In this case, we would determine that she is an employee, right? She does not control the hours that she works. She does not control the duties she performs, right? She doesn't set her own wage. So she is more like an employee, even though her employer is very small, it's very informal. This is more like employee income. Now, think about Gretchen. She owns a home and babysits neighborhood children there. Gretchen determines the hours, determines how much to charge, determines who is accepted as clients. Is Gretchen an employee or self-employed? So in this case, she is self-employed. She owns the business. She sets her own wages. She determines her own hours, and she chooses who she can accept as clients. This makes her more self-employed. So, Bilal, for your question, for gig employment, jobs like Uber and DoorDash, these are starting to become their own topics for us, but these same sort of guidelines apply. Now, from a company point of view, Uber and DoorDash clearly regard their workers as self-employed, as contractors, because then they don't have to pay benefits. And they do have some of the characteristics of being self-employed. They do own their own vehicle. In theory, they set their own hours and choose what jobs to take. They don't seem to control their own wages, and I'm not sure they have a lot of control over some other aspects of the job. So it is, in some jurisdictions anyway, some matter of dispute whether they should be employees or self-employed. But it does get complicated enough that it's its own topic. But in general, at a first blush, I would consider most gig economy workers to be self-employed. That is, they're being treated as contractors. But this does start to get beyond the scope of this course, where we're looking at more simple situations where it's a little clearer. Get back in. All right. With self-employment, you may sometimes have cases where someone comes in to do their taxes and it's not clear whether they're an employee or self-employed. So the CRA does publish a reference guide, RC 4110, employee or self-employed. I think it's referenced in your textbook. So in cases where you're having trouble making the determination, you can have a look at it and say, oh, okay, do these factors apply? Another question, though, is what is the distinction between someone who is self-employed running a small business and someone who is just doing odd miscellaneous jobs? We'll talk about more about that in a couple of slides. Okay, so 10100, first line on the return. This is the most common, by far, kind of income for most people. It's just employment income. And again, as you can see, there are some supplemental lines over here to the left, just for information purposes. Emergency services, volunteers, commissions, box 42, wage loss replacement. We're going to be talking about these tonight as well. But bear in mind, those are just for information purposes. Now, the T4 that we're talking about, this is the layout of it. You can also see an image of it in the Tax Academy reference book. So in general, when we're looking at these T-slips, you can pull up a copy in the reference book and have a look at it. I just want to talk about some of the general layout first. So up here in the upper left is information about the employer. At a minimum, we would see the name of the company, the name of the employer. The year that it's for is up here. It's important to pay attention to that because sometimes clients will come in to do their taxes and they'll have some forms mixed together, or they'll just shove a box full of forms at you. So you need to pay attention to what year the income is relating to if they're filing multiple years at once. The social insurance number comes in here. Now, a couple points. With the employer name, some companies, they will instead have the corporation designation. So someone is working for a restaurant in Vancouver, but it won't say Jim's Restaurant on it. It'll say BC Holdings 327 or something like that. So in those cases, you need to confirm with the taxpayer what this T4 actually refers to. With the social insurance number, it's not unknown for employers to make mistakes and put the wrong social insurance number on it, or leave the social insurance number blank, in which case you need to send the person back to the company to get them to issue the correct T4 with the correct social insurance number, because if it has the wrong social insurance number, it's going to cause problems with the CRA down the road. The name of the employee and their address is here. It does not matter if this is their current address or not. This is simply used when they are mailing the T4 to the employee. Up here in the upper right are certain boxes which are common to all T4s. So the province of employment, very important. If someone is exempt for CPP or EI, that'll show up here, but we'll talk more about that later. So right here, very prominently, employment income is in box 14, and income tax deducted is here in box 22. Now, some amounts have been withheld at source from the employee, typically. So normally you would see Canada Pension Plan contributions or Quebec Pension Plan contributions up here. If they had second tier CPP or Quebec Pension Plan contributions, they would be here, box 16A, 17A. EI premiums are down here in box 18. RPP contributions, that's registered pension plan contributions in box 20. We're going to talk more about those in a couple slides. Union dues, charitable donations also show up. These are all deductions from the employment income. And for some boxes which are not common to everybody, they will show up down here, and then the box number will be written here. So for example, a common one is box 40 for taxable benefits, or 42 for commissions. Pardon my bad writing. So commissions, these amounts down here are typically, not always, but typically included in box 14. So they don't need necessarily to be entered as income on the return, but commissions on box 42, for example, this amount is already included in box 14, but we enter the commission amount on line 10120 for information purposes. And that's because commission employees qualify for other employment expenses. Now, box 40 is for taxable benefits. Now, a taxable benefit, as I touched on last time, this is something you receive from the employer which is not money, but is still taxable. So, for example, if H&R Block gave me a benefit, like, say, paying for my healthcare premiums, that would show up down here. The main way you would notice this on a return is that taxable benefits are generally taxable, so they'd be included in box 14, but they're not subject to EI or CPP premiums. So your amount in box 24 is the amount of earnings that are subject to EI premiums. 26 is the amount of earnings that are subject to CPP pension. Often, if these numbers are lower than box 14, it will be because there's an amount in box 40. So, but that's really the only real effect you might notice on the return. Not all T4 boxes that you would see down here are going to be covered in this course. Some of them, for example, for fishers and taxi drivers, hairdressers, these are employees who have characteristics of self-employed workers, so they are beyond the scope of this course, and there are some other more exotic things we see down here as well. Some of them we're going to touch on in this course, and but generally if they're more complicated, they will be touched on in other courses, and some are much less common than others as well. Textbook illustration 2.5 sample T4. Let me have a look at that, Diane. Let's have a look at that. I assume you're not missing it, but let's have a look at that. So illustration 2-5, sample T4, and marker 6. Oh yeah, no, it's not there. Where is the $436 reference? Thank you. Someone just handed me an important document. I don't. Where do you see the 436? Note for. So not the tooltip here. Okay. At the bottom. Scroll down within the tool. Okay. Oh, that's probably why it got missed. Okay, I will point that out. It'll get corrected in our next round of corrections. Thank you. That's probably why that got missed. Okay, so, but yes, somebody probably left that in an early draft. If, however, there were a 436 here, no, thank you, Diane, I appreciate it. If there were an amount of $436 there, then we would expect, what I was saying earlier, if there were $436 here, then we would expect the box 24 amount and the box 26 amount to be less than the box 14 amount by 436. All right, good catch, Diane. Very much appreciated. Okay. All right. Okay, so now that we've kind of talked about the general layout of the T4, let me close that. One last thing I do want to mention is that sometimes you will see T4s which vary slightly from this format, although that's getting less and less common. The CRA specifies the format of T4s when they are to be printed out and sent to people. They need to adhere to certain formats. There are some non-standard formats which are nonetheless valid. So just because you get a T4 which doesn't look exactly like this, it doesn't mean it's not a valid T4. In particular, when you download T4 information from the CRA and print it out, it may not look like this at all. It may simply list the relevant boxes with the numbers on them. So the key thing is, do you have the relevant numbers for the relevant boxes? It is in fact possible, although I really don't like to do it, for someone to just give me T4 information verbally, and then I copy down the box numbers, and then we can put that into the computer, although that leads to the potential for error, so I don't like that. But in general, though, just because the T4 doesn't look exactly like this layout, this is just the most common, most standard layout. And as we're going to see, most other T-slips, sorry, I'm just going to go back. Most other T-slips do tend to follow this general layout of an area for the organization, an area for the employee, standard boxes which don't vary, and then open-ended boxes which do. We're going to look at some other examples in a little bit here. Now, let's look at an example of an unusual box. And again, this is a simple example which is suitable for this level of the course, just to give you an idea. So for example, emergency service volunteers. So these can be volunteer firefighters or search and rescue volunteers. And they may have some money in box 87, up to $1,000 in exempt income. So for these taxpayers, if they are claiming this as exempt income, then this amount is not included in box 14, and instead it is listed on, it is not included on box 14, but is instead on, sorry, it is instead on line 10105, right? And you can see information purposes. So the CRA goes, box 10100 plus 10105 is their T4 income plus the box 87. So you can see how that the logic there works. One other thing about emergency service volunteer income, a taxpayer might not want to claim this exempt income. We're going to talk more about this in our next session, Chapter 3, so we're not going to get hung up on it right now. We're going to have a broader discussion there. There are circumstances where someone might not want to claim this exemption, and in which case it is included in box 14 for reasons. So this is an example of some money that you received, which might or might not be reportable income depending on what the taxpayer wants to do. But even in the case if it's not taxable income, it is still reported on the return for information purposes. Now, other employment income, which I alluded to earlier, this is for things like odd jobs and casual labor, when you're working in some sort of job, but there is no T-slip associated with it. It's not on a T4. So this can be casual labor, just working around the neighborhood, or you're working very briefly for a company, so it's less than 500, so they don't feel the obligation to create a T4 slip, although companies often will. So for this type of income, it is reported on line, pardon me, line 10400 down here. As you can see, there's the plus sign in it, so it's added in. In general, any kind of employment income which is not on a T4 slip is recorded down here. Now, there's a few things. What defines casual labor? This is typically working for companies for less than $500, just coming and working for a day or two. There may not be a T4 slip there. Odd jobs, if you're working for people around the neighborhood, small things here and there. One thing we need to be careful about this with odd jobs is that they often, if someone has more than $3,500 of income from that in a year, then that meets the threshold to be considered as a small business and business income. And occasionally I do get into arguments with clients about this. But so long as it's less than $3,500 for the year, then it's going to be considered odd miscellaneous jobs by the CRA. If it's higher than that threshold, then the CRA rule is, oh, this should be considered as a small business. This is a small independent contractor, and you can run into issues if you try to claim that as other employment income on 10400. But again, the nature of the employment matters. Tips and gratuities are also reported on line 10400. We'll talk more about that on the next slide as well. The general rule of tips and gratuities is that the employer is expected to keep records of how much they received. The employee is expected to keep record of how much they received, and some kind of log so they have a recording of how much it was. Now, certain taxable benefits, certain other kinds of things are not considered regular employment income on line 10100 and instead show up in line 10400. We will touch on those in a couple of slides. But first, let's have a bit of a chat. So let's discuss a bit. So if a client comes in and they've got this kind of miscellaneous income, they may ask you this question: why should I report income that is not on an information slip? What kind of things could we tell them? It is the law, yes, but we want to be a little gentler than that. Really, there could be penalties if you're audited, yes. It may have been reported by the employer even if there isn't information slip. Good. Income may lead to your eligibility for credits. It's important to report all your income if you want some credits. In particular, although we're not going to talk about this for a few sessions, if you're claiming the GST credit, if your income is higher than zero, then you get slightly more back in GST credit. So it's not necessarily going to be it's not necessarily the case that reporting the income will lead you to paying more tax. Right. The returns benefits need to be accurate in order to get your accurate credits. And if you do not report the income, it could lead to tax owing later. right? Again, we want to stress to clients that the Canadian system is based on a self-reporting tax system. The CRA has the ability. We don't want to scare people with this unduly, but the CRA does have the ability to audit taxpayers if they suspect wrongdoing. They can randomly select someone for review, and they can go back 3 years to look at your taxes and if you were filing things accurately. In the cases of people where they have a lot of money showing up in their bank account, in extreme cases, say, okay, they could look at your bank records and say, oh, you've got money coming in every month, but this doesn't seem to have been reported anywhere. What is that? Say, for people who receive tips in the service industry, well, they might have this question. They might ask you, what percentage should I claim as tips? Have any of you heard of this idea? Because I sometimes get clients who work as servers who come in and they say, my manager told me I can claim X percentage of my income as tips. You do have to report your tips, and you do have to report all of them. What servers typically mean when they ask about percentages is they say, if I have $1,000 in wages, then my tips would be 15% of that. And that is, to me, a particularly annoying and persistent urban myth because that doesn't come from anywhere. It's not based in the law at all, but it is something that restaurant managers can pass down to employees. So, when you have servers, people working in the entertainment industry who receive tips, you have to kind of interrogate it a bit. Yeah, exactly, Christina. Sometimes their tips are included in box 14. If tips are added are paid through Interact, for example, that automatic tipping thing, normally that should be included in box 14, one would think. So you need to ask the client, are your tips included in box 14? If not, then they need to be reported. The amount of tips there are, of course, can vary. Someone working as a cook in the back of a restaurant will not be receiving the gratuities that someone as a waiter will. Someone who is a manager front of house will not be receiving the gratuities that a staffer will. So the tips, the expectation is from the CRA is that the server or the person will keep a logbook of their tips, how much they received and when they received, and then that amount is entered as other employment income on line 10400. So they should track them using a calendar or a spreadsheet. And the reason is, if the CRA audits that restaurant and the restaurant says, X amount of this money went to our staff in tips, then the assumption is, the legal assumption is, the CRA is correct, and it is the taxpayer's responsibility to provide proof that they are wrong. So the CRA says, in our experience at this type of restaurant, a server should be receiving 100% of their income as tips. So if you had $1,000 in income, you probably had $1,000 in tips, and it is up to the server to prove that that is wrong with their records. So that is what people are generally aware of. And every year or two, you have cases of a restaurant somewhere in the country getting audited for other reasons, and then all the staff having to pay a bunch of tax, and then it's all very sad because the staff are like, oh, no, we didn't know, how did this happen? So this is something we have to explain to people, and sometimes I have to explain to very upset people who just refuse to believe that this is the rule, but this is the rule. So I try to be very gentle with people. I try to explain it as best I can, but it is up to them to keep those records. And if something goes wrong and they don't have those records, then they have no legal recourse. All right. Now, other employment income In the textbook, it says that if there's more than one item on line 104, a supporting worksheet should be prepared. Is this a standard document? That's a good question, Diane. It's not a standard document. This can be as simple as a short list, which you prepare on a form. In general, the way I like to explain it to people, when we submit taxes to the government and there's an amount, for example, on line 104, 00, and there's no worksheet associated with it, or worksheets in general, remember, we don't submit these with the tax return. When this number goes to the CRA, you have to look at it from the point of view of the CRA. The CRA will look at it and say, there's, $700 here on line 10400. How did you come to that number? And you can, just a simple sheet of paper saying line 10400, the total of odd jobs, and this was $300 from job A, $200 from job B, and $200 from job C, with a total. That's all. It doesn't need to be anything fancy. It doesn't have a set format. So for a lot of things, when we talk about adding documentation, the way to think of it is it's just explaining to the CRA where a number comes from, what the number represents. We'll talk about that more when we get to moving expenses. Not today, but in the next couple sessions. So, but yeah, the basic rule is helping the CRA understand where a number comes from. Now, for income from a job, which is not in box 14 of a T4, it can sometimes show up on other slips. This is an information slip called the T4A. Now, the T4 part of it tells us that this is usually going to be related to income in some ways. But different types of income can be reported on the T4A. So, for example, it's often used for pension benefits that are paid out from a company pension. If there are dental benefits, those might show up here. If any income tax is taken off, it's also taken off taken off here in box 22, just like the T4. So that part is consistent. There are two boxes on here which are contractor income, self-employed income. So either self-employed commissions on box 20, fees for services in box 48. But other types of benefits down here will be taxable benefits that show up in line 10400. So some common examples, medical premium benefits, those would be a box 118. Box 119 would be group term life insurance plan premiums. Box 127 would be veterans benefits. Box 152 would be the supplementary unemployment benefit plan. We don't cover all the T4A boxes in this course, and in particular the self-employed commissions and fees for services. That's business income, that's beyond the scope. Just be aware that things that show up down here, you'll need to look up the individual box to see if it's reported on line 10400 or on some other line. Okay, all right. On that note, we have come to the break. Let me just check where our time is. Let's see what we're doing here. 7:36, that's about the right time for a break. So let's take a break for 15 minutes. Doreen, we can stop recording, and good job. There we go. All right, so let's get back into it. So one thing, the next thing we're going to look at are what's called group sickness or accident insurance plans. So if you're looking at your T1, we've already talked about tax-exempt income for emergency services volunteers, and we've talked about commission employees. They'll have an amount down here. But there's also an amount for wage loss replacement contributions. So you might be thinking, hey, what are those? Well, these are plans which provide employees with replacement income in case of injury or other situations. And they can be a little confusing to handle sometimes because they come in different varieties. So there are some basically two questions we need to ask. And the first question is, who puts money into the plan? Where is the money coming from? So if all of the money has been contributed by the employee, then when they receive money from the plan, then they are just receiving their own money back. So it's not new money, it's not income. So in this case, in an employee pay-all plan, no slip is going to be issued. So when we talk about, by the way, group sickness or accident insurance plans, this is the generic CRA term for all of these various plans. But for employee pay-all plans, they have no tax implications because the employee is just getting their own income back. The second variety, though, is called a wage loss replacement plan. And this is where the employee and or the employer and possibly the employee as well, put some money into the plan, and what the employee is getting is therefore new income coming from the employer. Now there's two varieties of this, and we're going to see this pattern with a few other things as well. Sometimes the employer puts in money, sometimes the employee puts in money, sometimes both. So we're going to see this in a few other cases as well. For the case of wage loss replacement plans, the first question as to how we handle this new money on the tax return is whether or not the employer exercises control over the plan. If the employer exercises control over the plan, that is, the plan comes through the employer and not a third party, then this income will be included in box 14 of the T4, and it is included in line 10100, the T4. If it's through a third party, like Manulife or something like that, there is no employer control, and this money will show up as separate money on a T4A in box 107, and then it is reported on line 10400. So that's the first question. The second question is, if the employee contributed to the plan, how much? Because that is not new money, and that therefore can be deducted from the amount which has to be reported. So when the employee contributes to the plan, and remember, in some plans it may be entirely employer-based, but if, get back here, if the employee put money into the plan, then the amount which they receive in a year is reduced by the amount which has already been paid by the employee, which hasn't been claimed in a previous year. So if the employee puts $1,000 into the plan and then they get $1,000 back from it, then there's no net new income, and so they don't have to report any additional income in the year. This reduction, however, cannot exceed the plan income for the year, so it cannot drive the number below zero. So if you got $1,000 from the plan, but that was already paid by previous employee contributions, any additional contributions the employee made cannot be claimed in this year as some kind of reduction or deduction. So it cannot be reduced below zero. And again, this is a pattern we're going to see in a few other things going forward. Documentation, typically a letter from the employer, is required to confirm the amount of the employee contributions. And then, depending on whether, and again, remember, it depends on whether the back button, there we go. So if the employer exercises control, it's going to show up on a T4, and if it's through a third party like Manulife, it'll show up on a T4A. So if the income is reported on a T4, then the amount of employee contributions reducing that are reported on line 10130, and only the net amount is included in line 10100. But if income is reported on the T4A, only the net amount is reported on line 10400, and no additional entries need to be made. So let's look. There are some more detailed explanation in the textbook, but let's look at the examples from the textbook 2-7 and 2-8. So, to help illustrate. So here's one from a T4. here's one. Okay, so Bill suffered an injury last year and continued to receive income from the employer under the company wage loss replacement plan. He has received only a T4 from his employer and a letter from the employer stating he's contributed $500 a year to the company plan over the last 5 years. So that would be $2,500 total. The letter states that the plan paid out $8,000 in benefits this year. It's been included in income, and this is the first year he's received benefits. So what would this look like on a T4? So first of all, line 14 here includes his total employment income for the year. But box 40 tells us that $8,000 of that $41,500 is some kind of taxable benefit, and we know what it is. We know it's the wage loss replacement plan. So what goes on the return then? The T4 box 14 is $41,500. We deduct his employee contributions for the last 5 years, so that's $2,500. So what shows up on line 10100 then is only the net amount, $39,000, and the $2,500 is down here on line 10130 for information purposes. So, and you can see the logic. If the CRA says, this T4 says $41,500, but that would be $39,000 plus $2,500. Okay, that makes sense to us, right? So you can see how this is handled for the CRA. Now, in the case where it's a third party, like Manulife, so we've got Frank here, and he has wages of $34,000. That would show up on a T4. But he also has a T4A showing $1,000 from the insurance company with wage loss replacement plan benefits. So that shows up on a T4A in box 107. He made annual contributions of $200 for the last 3 years, and this is the first time he's received benefits from the plan. So how does this handled on the return? So the T4A itself, very simple. We just shows the $1,000 in box 107. Then we deduct the $600 he's contributed. So that means only $400 needs to be reported on the return, and that's going to show up here on line 10400, and the $34,000 from the T4 is on line 10100. Right? So hopefully that's clear enough. Again, there's more detail, a more detailed discussion in the textbook. Key thing to consider is, again, you have to ask the questions in sequence. Did the employee pay all of the premiums, in which case there's no income tax implications? If the employer paid all the premiums, then you simply report it as it shows up on the T-slip. It's only in the case where the employee and the employer both contributed that you need to make this calculation, and then how it's reported on the return depends on whether it's on a T4 or a T4A. So here's an example. We're going to be giving you some questions here. How much to know the employee paid? Christina, good question. That will need to be in a letter or a statement from the employee who will specify it. The T4A would be whoever the third party is. We'll look at, we'll give you an example in a second. So for example, let's consider this. Who issues it? Well, if Patty receives wage loss replacement income in 2024 and the employer has control of the plan, is that going to be on a T4 or T4A? Good, good. You're all paying attention. This would be a T4. Excellent. All right. Now, let's look at another example, or more about this example. So let's assume she's received wage loss replacement income for the first time in 2024. The T4 shows $50,000 in box 14, and she has a letter from her employer stating that $3,000 of box 14 is plan income and that she has contributed $1,200 annually beginning in 2022 for a total of $3,600. Again, it's on a T4. Her employer exercises control of the plan. So, first, does any amount go on line 10130? Yes or no? Okay, the answer here is yes, because she has made some contributions, and those are going to be deducted from what is reported in line 10100. How much is going to be reported on line 10130? Good. $3,000, Valerie. That's exactly right. You cannot deduct more than you actually received. So this person only received $3,000, and it's already been included in box 14. So only $3,000 can be deducted. That shows up on line 10130. And therefore, what amount goes on line 10100? Very good. 47,000. Right? So the 50,000 in box 14 on the T4 is reported as 47,000 on line 10100 and 3,000 on line 10130. And only the 47,000 is going to be part of the what's added up to produce total income. So next question, what would be different, if anything, if the employer did not control the plan, if it was through a third party such as Manulife? So how would it be on a T4A? How much would be on the T4A? $3,000. Good. So the $3,000 will show up on a T4A from Manulife, and that $3,000 would go on line 10400. Bear in mind, there would still be a T4 for the regular employment income. So they would still get a T4 from the employer for the $47,000. And no adjustment would be necessary here. Now this, assuming everything else is still the same, that she still made the employee contributions, then no entry needs to be made on line 10130. That's only for amounts which are in a T4. So the amount here, she received $3,000 from the plan, but she's already had employee contributions of $3,500. So in this case, 0 would be entered on line 10400, but you would still need to submit the documentation to the CRA, that letter from the employer saying, here, this person received this much from Manulife, but she's already contributed this much, and none of them has been completed. So you can see this. This isn't something we expect anyone to memorize, by the way. And I just want to stress that again and again in the course. We're not expecting you to memorize all this information, but simply to understand how it works and where you can look it up in the textbook. So, B-Lab, that's an interesting question. You are asking, do you need to do any calculations on your own if you use software that's verified? You just need to do data entry, right? No. It would. If that were the case, I wouldn't have a job, really. Some of the data, you need to do calculations in order to enter it. The best software in the world cannot read that letter from the employer, right? The $3,000 which has been already paid, there's nowhere to enter that in the software. So these kind of calculations we often have to do manually. So that's part of it. As well, a lot of things, if the software makes a mistake or something's been entered in the wrong way, then being able to do the calculations manually is important, because sometimes we need to understand when something's gone wrong and how to fix it. So in this case, the employer will send the letter. Manulife would not necessarily know how much the employee has contributed, so the employer needs to verify it. That would be what I would expect. All right. Now, briefly, we're going to touch on research grants, although I don't want to spend a lot of time on it because I want to be able to spend more time in the chapter review problems. So research grants, these can also show up in a T4A in box 104. This is another case where you can deduct expenses from the research grant, but the expenses cannot exceed the total research grant. In other words, you can't produce a negative number. So only the net research grant, that is the research grant minus expenses, is reported on line 10400. In the textbook, there's examples of allowable and non-allowable expenses. Just for time purposes, I don't want to get into that right now, but you can assume for almost anything like this, certain expenses are going to be allowed and certain expenses are not. Research grants, if you're unfamiliar, this is when a university or other higher institution of learning provides grant money to an individual or group in order to conduct research into a subject. This is typically not scholarship income. We will talk more about scholarships when we talk about students in Chapter 13. Research grants are typically for individual products or projects or postgraduate research study. But typical expenses would be things like equipment, payments to participants, that sort of thing, and not for things like living expenses. All right, one other T4 slip I want to mention to you, and again, the T4 just indicates that it has something to do with income, something related to income. This is the T4PS. The PS stands for profit sharing. And again, you can find this in the Tax Academy reference book. It's an unusual slip. Just as the T4A can have different kinds of income on it, the T4PS can have investment income on it. So you can have dividends up here, capital gains here, and even foreign income down here, all of which we will talk about when we talk about investment income. But the other thing that can be on here is other employment income in box 35. And this is reported on line 10400 as well. T4PSs are typically issued by big corporations, which allows employees to participate in a profit sharing plan. So this is why we typically see dividend income on these slips. A few big Canadian corporations offer this. TELUS, for example. So while I don't see these very often, I see them once or twice a year, typically. So this is one more slip which can have other employment income on it. Again, the thing to remember is that box 10100 is only for income from box 14 of a T4 slip. Other income will typically go on line 10400 if it's from employment or related to employment in some way. Now, here's a question, and I suspect a more detailed answer is in the textbook if you want to pull it up, or as opposed to answering off the top of your head. But when we are calculating other employment income, what would be reported on line 10400? Vacation pay, bonus, or casual labor? So I'm just going to open up the old poll here, make sure I have the correct poll question. Let's give you a minute to give this a try. 10 more seconds. Some people are still thinking. Five more seconds. 3, 2, 1. Okay. And if the window is open, WebEx makes me wait while it gives a chance for that person to put it in. All right, so the correct answer here is C. Vacation pay and bonuses typically are included in box 14. They are part of regular income from an employer, even if they are distributed unusually through the year. They do not go on a separate slip. Exactly, Grant. Casual labor is the only thing which would not be on a T4 slip and would go on line 10400. All right, so the first step of the tax return then is calculating total income. So, and we've looked at some basic examples of employment income and how that would be handled. So, key thing, the total income is calculated in the furthest right column, step 2 of the tax return. So we add together all amounts in the furthest right column. Sideline amounts, lines 10120 and 10130, are for information purposes, and the total income is reported on line 15000. So again, let's bring up the, not that one, this one. Get back here. All right, so the totals are totaled up down here. The sideline information is down here. And then after the entire column is added up, it gives us the total income amount here on line 15000. That then transfers through to the top of the next page where we calculate net income. So I think I mentioned before, but you can think of the entire T1 return as one long equation, one long flow chart that you just work through in order. So we're just walking through all the steps right now slowly to give you a basic idea of how the return works mechanically. So the total income is transferred to the top of the next of page 4, step 3. In step 3, what happens is that we add together various things that we are going to deduct from total income to give us our net income. And we're going to look at some simple examples of things which are deducted here. We're going to look at registered pension plans, union dues, and how they are deducted. Again, just to give you some simple examples. So with net income, again, the addition happens in this column. Information over here is for information purposes for the CRA. It's all totaled up and deducted here. Then we have the net income before adjustments. If someone has to repay social benefits, those are deducted here. We'll talk more about that in future chapters. And then net income is at the bottom at line 23600. Now, deductions here, some of these appear on the T4. In particular, union dues in box 44 and RPP contributions in box 20. We're going to talk about these on the upcoming slides. Box 52 here, the pension adjustment, is related to box 20, but is not directly added to anything on the return. It's more for information purposes, as we will see. So, RPP stands for Registered Pension Plan. This is a private pension plan, a company pension plan. So you pay amounts into the company pension plan. The company or a third party working for the company administers it, and then when you retire, it's paid out. These have become less common over the years as companies are less and less likely to do this, but they are still relatively common, particularly for large